Hi, Sean Sevey with Sevey Wealth. Today we're going to talk about the role of individual stocks in a client's portfolio. We own stocks for long term growth and to offset inflation. And there's a number of ways that we can own stock based investments in a retiree's portfolio. Whether we use an index fund or individual positions, there are ways to tailor a portfolio around a client's needs and desires. But should we pick one or the other, index funds or individual stocks? In our opinion, no. You should have a mix of both. We're going to explain that right now. When we talk about the risks that an individual stock has, it carries many of the same risks that an industry fund, a sector fund, or even the broad based index funds all carry. What's the general economic outlook? Are earnings in line with expectations or above or below? But when we get down to the individual stock, there are additional risks that we take that are not true of a more diversified approach. When we think of an individual stock, we have to also consider what's called headline risk, or a risk that comes out specifically around the individual stock. And let's give you some examples. In this example, we're looking at Apple. Apple is part of the consumer electronics industry, which is part of the technology sector, which is part of the S&P 500. As anyone who's owned Apple for the last 10 years will tell you, having a structural overweight to a company like Apple has been an amazing way to add value to the portfolio. But as we all know, not all companies are created like Apple. When we take specific company risk, we add in the headline risk that that particular company has compared to the industry sector or the broad-based market. And I highlight BP or British Petroleum here. If you remember back in 2010, one of the worst Gulf oil spills happened on the British Petroleum Deepwater Horizon oil rig. And news of that immediately sent the stock down by just about half in the coming weeks. Shares eventually did recover, but it's important to understand the specific company risk and the need to hold through the down market and through the bad news and wait for a recovery. Not all clients, A, can afford to wait, and B, have the tolerance and the patience to wait during these types of events. The news of the BP oil spill not only affected the individual stock, but all integrated oil and gas companies, all energy companies, and the S&P 500. But the further we get away from the individual stock, the less impact the specific company risk played on the industry, the sector, and the broad-based index. Another example of specific company risk is a company like Meta, formerly Facebook. Meta is part of the internet and content information industry, which is part of the technology sector, and of course, part of the broad-based S&P 500. In September of 2021, we saw shares of Meta fall precipitously after leaked internal documents hit the market. The stock, within a matter of a year, lost almost 70% of its value. While these shares also rebounded over time, it does point to the discipline and patience required of owning an individual stock during volatile times. At CV Wealth, we believe that if you're going to own individual stocks, then there are four principles that you need to adhere to. The first one is that you must have an absolute conviction the stock will outperform its assigned index to justify the enhanced risk. If you lose that conviction, it is time to sell. Two, we're never married to a stock, but we can have a long-term relationship with it for many, many years. Three, never let the tax tail wag the dog. Paying taxes means we made money, and if we've lost our conviction in the stock, we'd rather take our proceeds and find another place to put those proceeds. And finally, four, sector funds are an excellent way to take advantage of trends to give us a structural overweight without taking specific company risk. So what does this all mean for your portfolio? We want you to have absolute conviction in what you own. When tough times come along, and they will, we need to know that we have quality in our portfolio, not some tip our buddy gave us at the last time we got together. We want to know what could happen both in up and down markets. And we want to know what each individual position is designed for in our portfolio. Is it there for long-term growth, to generate income via dividends, or to serve as a legacy position to pass on to your heirs? Individual stocks have their place in a diversified portfolio, but you have to know why and you have to know when it's time to move on. For those of you who don't know, I started CV Wealth as a wealth consulting company, not a management company. We're here to educate you and support you to manage your own wealth so you don't pay high fees to traditional firms. If this sounds interesting or have further questions on today's topic, we'd love to have a chat. Until then.